Gold touched $5,400 on Monday. Then it dropped 2.5% in a single session to $5,180. War is raging in the Middle East, the Strait of Hormuz is closed, and yet gold is falling. If you are holding gold right now and you do not understand why this is happening, the next few weeks could cost you everything. Welcome to Capital Anchor. I break down what is actually happening in markets while the mainstream media keeps you distracted. If you are new here, subscribe right now, because what I am about to show you could completely change how you see gold and everything you thought you knew about safe haven assets. Let us start with exactly what happened. On February 28, 2026, the United States and Israel launched coordinated aerial strikes against Iran. They killed multiple top military leaders, including Supreme Leader Ayatollah Ali Khamenei. Markets immediately went into shock. Gold surged from roughly $5,100 to above $5,300 in a single session. By Monday, March 2nd, it had pushed all the way up to near $5,400, hitting the upper boundary of a rising channel pattern that technical analysts had been watching for weeks. Then something unexpected happened. Instead of continuing higher, gold reversed hard. By Tuesday, March 4th, it had dropped 2.5%, back to $5,180. The RSI fell from above 80 all the way down to 49. That is a massive collapse in momentum in less than 24 hours. Meanwhile, Iran retaliated. They closed the Strait of Hormuz. They struck Israeli territory. They launched drones at the U.S. Embassy in Riyadh. The war did not stop. It escalated, and gold still dropped. Most retail investors are completely confused right now. War equals gold up. That is the simple formula everyone learned. So why is the opposite happening? Here is the mechanism almost nobody is explaining. Think of gold and the US dollar like two people on opposite ends of a seesaw. When one goes up, the other typically goes down. Under normal circumstances, war creates fear, fear triggers safe haven buying, and gold rises while the dollar weakens. But here is what changed on Tuesday. The war itself started pushing inflation higher. Oil benchmarks jumped over 8% in a single session after Iran closed the Strait of Hormuz, because roughly 20% of the world's oil supply moves through that choke point. Higher oil means higher prices at every level of the economy. And here is where the seesaw broke. The US ISM manufacturing prices paid data for February was released on Monday. It came in at 70.5. The estimate was 59.5. The previous reading was 59.0. That single number 70.5 told the market that factory-level inflation was already running dangerously hot before the war even started. Suddenly, traders started repricing Federal Reserve expectations. The probability of the Fed holding interest rates steady in June jumped from 42.7% to 53.5% in a matter of hours. That is a seismic shift. When rate cut expectations fall, the dollar strengthens. A stronger dollar makes gold, which is priced in dollars, more expensive for every buyer using euros, yen, rupees, or yuan. In one day, gold lost two of its three tailwinds simultaneously. The rate cut fuel dried up, the dollar surged, and the geopolitical bid, while still present, was not enough to overcome both headwinds at once. This is reason number one: gold dropped despite active war. Reason number two is technical positioning. Gold had rallied for consecutive days before Tuesday. By the time it hit $5,400, it was pressing against the upper boundary of a rising channel, one of the most closely watched resistance zones in technical analysis. The 14-period RSI was above 80, which signals extreme overbought conditions. Professional traders who had been long from $5,100 used the $5,400 resistance as an exit point. That selling pressure, combined with the dollar surge, created a cascade. Reason number three is the inflation trap. This is the one nobody in mainstream media is talking about. When geopolitical conflict is also inflationary, it forces central banks to stay restrictive. The European Central Bank is now expected to hold policy steady as energy prices surge across the continent. The Fed is recalibrating. Tight monetary policy means higher real yields. Higher real yields make gold, a non-yielding asset, relatively less attractive compared to bonds. Gold does well when real rates are falling. Gold struggles when real rates are rising or holding steady, even if nominal inflation is climbing. This is the critical distinction most retail investors never learn. Now here is the part that should make you sit up. While retail investors were buying gold at $5,300 and $5,400 on Monday, celebrating the geopolitical surge, institutional traders were quietly reducing their long positions. COMEX data shows that the RSI reaching above 80 triggered systematic profit-taking by algorithmic and hedge fund strategies that had been accumulating since gold was trading near $4,400 in late January 2026. The mainstream narrative told you, war equals buy gold. The institutions heard, war equals inflation equals no Fed cuts equals sell the overbought position. While you were following the headline, they were following the interest rate model. Chinese gold consumption surged 12% in January 2026, according to market data. Central banks are still buying. ETF inflows remain robust. JP Morgan has gold forecasted to average $5,055 by Q for 2026. These are not bearish signals. The structural bull case is completely intact. But in the short term, the same event that everyone told you was a guaranteed gold catalyst, the Middle East war, has actually created a ceiling, not a floor, because of what it does to rate expectations and the dollar index. The $5,000 psychological level is now the line that every serious trader is watching. A clean break below $5,000 opens a path toward the lower rising channel boundary near $5,065 first, then potentially further. The $5,400 upper boundary remains the key resistance above. But the most important thing to understand right now is that what you are watching is not gold failing. What you are watching is gold being temporarily trapped between two forces that are fighting each other in real time. And what happens next in the next few weeks depends entirely on which force wins. But the scenario that most people are not even considering yet is the one that could move gold the most violently in either direction. Let us go back to October 2023, because history is about to repeat itself in a way that most people will completely miss. When Hamas attacked Israel on October 7, 2023, gold was trading near $1,820. Within 3 weeks, it surged to $2,009, a 10.4% move in 21 days. Then it pulled back sharply to $1,985 before resuming its climb. The pattern was identical to what we are seeing right now. Initial spike on geopolitical shock, pullback driven by dollar strength and hawkish Fed repricing. Then a sustained move higher as the structural demand factors reasserted themselves. That 2023 pullback lasted approximately 18 trading days before gold found its footing and resumed higher. We are currently on day 2 of this pullback from $5,400. If the 2023 pattern holds, the window for accumulation may be shorter than most people think. Now let us talk about what has not changed, because this is where retail investors make their biggest mistake. They see a 2.5% drop and assume the entire thesis is broken. It is not. Central banks are still buying gold at a historic pace. In 2022, they purchased 1,136 tons, the highest on record. That pace continued through 2024 and 2025. China, India, and Turkey are still aggressively adding to reserves. That demand does not disappear because the RSI hit 49. The Strait of Hormuz closure is still active as of March 4, 2026. Approximately 20% of global oil supply is disrupted. That is a structural inflationary shock that will keep real rates complicated for the Fed for months, not days. De-dollarization is still accelerating. BRICS nations settled 65% of mutual trade in non-dollar currencies in 2025, up from 26% in 2020. Each percentage point of de-dollarization represents incremental demand for gold as a reserve asset outside the dollar system. Supply constraints have not changed either. Global gold mining output grew only 0.5% in 2025. Meanwhile, central bank and ETF demand has absorbed supply at a rate that has kept physical inventory tight at COMEX for over 14 consecutive months. The thesis is intact. The price is temporarily volatile. These are two completely different things. Now I am going on the record with a prediction. Screenshot this. Gold will reach $5,650 by June 30, 2026. Here is why. The Strait of Hormuz disruption will eventually be resolved diplomatically or militarily, but the inflationary damage will take 3 to 6 months to feed through into economic data. By April and May, that data will force the Fed to choose between fighting inflation and preventing recession. When that fork in the road arrives, the market will price in rate cuts regardless of inflation, because the growth risk will outweigh the inflation risk. That is the moment the dollar weakens and gold gets its next sustained leg higher. Now let me give you the 3 scenarios. Scenario 1. The Strait of Hormuz reopens within 2 weeks, oil prices pull back, and the Fed's June rate decision remains uncertain. Gold consolidates between $5,065 and $5,280, then breaks higher toward $5,650 by late Q2 2026. Probability, 55%. Scenario 2. The conflict escalates further. Oil stays elevated above $110 per barrel. The Fed signals it will hold rates through the end of 2026, and the dollar index pushes above 108. Gold gets pressured toward $4,900 before finding strong institutional buying support. Probability, 30%. Scenario 3. A broader regional war pulls the U.S. into direct sustained conflict, triggering a global risk-off event so severe that gold breaks $5,400 resistance and surges directly toward $6,000 within 60 days. Probability, 15%. Now let me speak directly to each type of person watching this. If you are holding physical gold, your only job right now is to do nothing. Physical gold holders are not affected by a 2.5% intraday swing. Your thesis is measured in years, not sessions. The structural demand behind your position has not changed by a single ton. If you are trading with leverage, this is a moment for discipline, not courage. The $5,000 level is your line in the sand. If gold closes 2 consecutive days below $5,000 on high volume, reduce exposure. Do not average into a falling leveraged position while a currency war and a real war are both running simultaneously. If you are sitting on the sidelines with cash, this pullback is worth watching carefully. A move toward $5,065 or the $5,000 psychological level, if it holds as support with a reversal candle on the daily chart, is the signal the market is giving you. That is not financial advice, that is reading the same chart that institutional desks are reading. If you bought near the top at $5,300 to $5,400 and you are now underwater, understand what you own. You did not buy at the wrong price, you bought at the wrong moment in a technical cycle. The trend is still your friend as long as gold holds above the rising channel lower boundary near $5,065. If that level breaks and closes below it, reassess. Until then, the panic is premature. Now here are the 4 specific indicators you need to watch every single day from this point forward. Watch the DXY, the US dollar index. If it pushes above 107, gold will face continued headwinds regardless of geopolitics. If it rolls over below 104, gold gets its fuel back. Watch COMEX gold inventory levels. 14 consecutive months of tightening inventory is the silent bull signal. If that number starts declining faster, the physical market is telling you something the paper market has not priced in yet. Watch the CME FedWatch tool probability for the June Fed meeting. Right now it shows a 53.5% chance of no cut. If that number moves back below 40%, gold breaks higher fast. Watch Brent crude oil. It is the canary in this particular coal mine. If oil holds above $105 per barrel due to the Strait of Hormuz closure, inflation expectations stay elevated, and the Fed stays hawkish. If oil drops below $95, the inflation pressure eases, rate cut odds rise, and gold finds its next leg. Now let me tell you about the 3 types of people watching this video right now. The first type is panicking. They are checking the price every 20 minutes, they already sold half their position on Tuesday, and they are trying to time the exact bottom. This person will miss the recovery and buy back higher, exactly like they did in October 2023. The second type is frozen. They understand something is happening, but they cannot decide whether to add, hold, or reduce. They will wait for perfect clarity before acting. By the time the picture is perfectly clear, the move will already be 80% complete. The third type is learning and preparing. They are watching indicators. They have their levels written down. They understand the mechanism, not just the headline. They know that $5,000 is the level that matters, and they are ready to act with a plan when the market gives them the signal. Every wealth transfer in market history moves money from the first 2 groups to the third. Markets do not destroy wealth. They redistribute it, from the impatient to the patient, from the reactive to the prepared, from the people who follow headlines to the people who follow mechanisms. Gold dropping 2.5% in a single session while a war rages in the Middle East is not a contradiction. It is a lesson. The lesson is that the same event can be bullish for gold in the long term and bearish in the short term simultaneously for reasons most people will never take the time to understand. You just took that time. That is what separates the third type from everyone else. Gold hit $5,400 and pulled back hard. That headline scared most people. But the people who understand what is actually happening are not scared. They are watching for specific indicators, waiting for one specific price level, and holding. A thesis backed by central bank buying, a closing straight, and a de-dollarizing world. If this video gave you a clearer picture of what is really going on, hit the like button and subscribe to Capital Anchor right now. Share this video with someone who is panicking about gold this week. They need to see this before they make a decision they will regret, and drop a comment below telling me which type of person you are. Type 1, Type 2, or Type 3. I read every single one. This is not financial advice. Do your own research before making any investment decisions.